This is Ryan McKenna with Outshine Realty. I wanted to do a quick video about homebuyer loans and cover all the different things involved in that. There's a lot of myths about buying a home or getting a home loan that you have to have at least 20% down. That's not always true and often not true. There's a myth that you have to have a perfect credit score. That's not always true either. You can have a less than perfect credit score. You don't have to have 700 or 600. You sometimes can go even lower than 600. It depends on the lender and the type of loan. There's another myth that you have to go through your bank. You don't. You can go through other types of lenders like your credit union or a mortgage company that just deals with lending money for homes. Sometimes you get better deals through those, so it's good to shop around a little bit. There's different types of home loans. There's conventional, FHA, VA, USDA, and jumbo loans. There's some other loans for construction and investors, but we won't go into those. That's probably a whole nother video. With the conventional home loan, typically it's a down payment of anywhere from like 3% to 20%. I've seen a lot of people do 5% as a norm. However, whenever you put less than 20% down, you do have to pay PMI, which is insurance that goes to the mortgage company to help in case you default on the loan. It's just an extra payment that you have to pay. If you can avoid it, try to get the 20% down, but a lot of people don't have it. So you do have to pay this extra fee if you don't. That's just something for you to know if you go a conventional loan route. The interest rates are typically better with a conventional loan if you can get a conventional loan. Also, the credit score qualifications are a little higher for a conventional loan than for some of the other loan types. And then the loan limits are set up by the FHA, so you have to check and see if your home is within those loan limits. FHA loans, those are government-backed loans. A lot of people think that you can only get an FHA loan if you're a first-time home buyer, and that's not always true. You just have to realize that the FHA loans, they might have a little bit higher interest rate. So sometimes that's why you want to go with conventional if you can. Also, the inspections are a little bit more brutal. So some home sellers would prefer a conventional loan over an FHA if possible. But FHA is definitely a good way to go. You can go as low as 3%. And some lenders, it depends on the lender, but some lenders can go at 580 or maybe even a little lower on the credit score. It just depends on the lender. VA loans, these are for veterans or people that are active duty military or people that qualify, like family members that may qualify. There's no down payment required, which is awesome. Competitive interest rates. You don't have to pay the PMI, which is great because all the other loan types, if you don't put down an adequate amount, you have to pay PMI. There's flexible credit requirements and there's assistance for veterans that need it. The only downside of VA loans that I can ever tell is that in a seller's market where the buyers are having trouble buying houses and there's multiple offers, sometimes the VA loans get overlooked because they're a little more strenuous on the inspections than the other loan types. So whenever you use a VA loan, you have to make a pretty good offer to get your offer to stand out, as far as the purchase price. USDA loans, these are loans that are for properties that are qualified for USDA, which is generally homes that are out in rural areas. But sometimes I've seen these closer into town. Like some of them are even a mile away from like a Walmart in parts of Broken Arrow and Bixby and places like that, or Owasso, like where it's more of a rural suburb. You probably wouldn't be able to get a USDA loan in like a bigger city area, more metropolitan area or whatever. But whenever you find one, you can actually do searches for USDA properties. Whenever you find a USDA property, they can be beneficial to you because you can often get these properties with nothing down, and that saves you a ton of money out of pocket. You do have to qualify for these loans, so you have to talk to your lender and see if it's something that works for you. Jumbo loans, these are for people that want to buy a very expensive home. Oftentimes, they're higher value properties. They're stricter when it comes to the requirements and all of the underwriting procedures. And sometimes the interest rates could be higher. You just have to shop around to find the best rate and make sure you're getting the best deal on your loan. So the eligibility requirements for your loan: you have to have a good income or have an income. You must have a credit score of some kind, and it must preferably above 580, but sometimes they can work with lower. Employment history is good. It's good to have at least 6 months. 2 years is better. They want you to have a history. If you don't have a good history, it's good if you're just switched jobs and you've always stayed in that same industry. That's also helpful versus you just starting out a new job in a new industry. That doesn't look as good. Debt to income ratio: you want your debt to be at a good amount so that you are not having so much debt that you can't afford the home. You want to be able to afford the home, and they're going to make sure that you can by making sure your debt to income ratio is within a certain amount. Down payment: you want to save that up, but like I said, you can start with as low as 0% down. You still want to have moving expenses, and you have to have what's called an earnest money deposit, which is typically $500, but it could go up to $2,000. So I would say save up, at least $5,000 just to cover your moving expenses and your earnest money and other things that you might be required to have. You can ask the seller to pay some or all of your closing costs to help you out in this purchasing process. And then you have to know your property type because there's certain exclusions. You want to make sure that they know what type of property you're looking for and what you're going to buy. So where do you go from here? You contact me, Ryan McKenna at Outshine Realty, and I'll hook you up with lenders that can help you get to where you need to be. So they'll look at everything and they'll let you know, are you in good shape? They might say, hey, you're good to go. Or they'll say, you need to adjust a few things. Like maybe you need to wait a little longer on your current job. Maybe you need to improve your credit score by paying off a bill. Maybe you need to pay off a debt or something, or raise a little bit more of a down payment, maybe something like that. So after you do those things, they'll come back to you in like a month, 2 months, 6 months, whatever it is. And then they'll say, now you're good to go. And they'll make suggestions and guide you through the whole process. And then you're ready to go and get away from paying rent every month to a landlord that you're making him rich when you could be putting that money in your pocket as equity in your property. And oftentimes the payment on the property you own is less than a rental. So that's something you definitely want to look into, is buying your own home and having that security of having that money in your pocket and having an asset that you can control. It often makes sense for most people, and that's the goal. And a lot of people don't understand that they can buy a property. They just don't know. They haven't looked into it or evaluated it. So that's what you want to do. You're not going to lose anything by looking into this. It's not a waste of your time, because if you don't qualify now, you at least get a plan to qualify later, and you can get a plan to get into a home. And we'll help you find your home. We'll help you get the financing, and we'll help you get to that point where you want to get out of the rental rat race and get into a property that's going to help you. Contact us, Ryan McKenna, Outshine Realty. Thank you.